757%. Just let that number sink in for a second. That massive figure right there, that represents Dell's explosive year-over-year AI server revenue growth. Dell has basically crowned itself the undisputed AI server leader, and today we're giving you the complete guide to investing 2 times in this massive boom. We're looking at a market that is moving at absolute warp speed right now, and we're going to unpack exactly how you can, or honestly maybe shouldn't, navigate it using specialized financial instruments.
Welcome to today's Explainer, where we are doing a complete DLLE ETF fact check. This is your potential 2 times leverage ticket into Dell's dominance. First, we'll look at the fundamental momentum of the underlying stock, and then we're going to peel back the curtain on the hidden structural risks of using synthetic single-stock leverage.
All right, here's our roadmap for today. Number 1, Dell's AI server boom. 2, doubling down with DLL. 3, the daily reset trap. 4, beware of volatility drag. 5, hidden costs and risks. And finally, number 6, your tactical investment guide. Let's kick things off with Section 1, Dell's AI server boom.
You know, Dell has completely transformed. I mean, they've shifted away from just being that traditional PC hardware company you probably remember into an absolute enterprise AI powerhouse. Just look at this surge. We're talking $16.1 billion in AI-optimized server revenue in a single quarter. Total revenue reached nearly $43.8 billion. And then there's the backlog. A staggering $51.3 billion with a B in orders just waiting to be fulfilled. That proves demand is vastly outpacing their current supply. Guys, this isn't a slight quarterly bump. This is a massive structural shift in their entire business model.
Jeff Clarke, Dell's vice chairman and COO, really hit the nail on the head when he said the AI opportunity is completely transforming the company. What we are witnessing here is a massive enterprise shift towards agentic AI. Now, if you're wondering what that means, agentic AI actively manages complex workflows and makes decisions. It's way beyond just chatbots answering simple prompts. Running that kind of intelligence requires massive, liquid-cooled data centers, and Dell is the one supplying the essential hardware to actually make it happen. The fundamentals here, they are undeniably strong.
So, if Dell is the fundamental powerhouse, how do you supercharge your exposure to it? That brings us to Section 2, doubling down with DLL.
Enter DLL, the Granite Shares 2x long Dell Daily ETF. I want you to think of DLL like a high-performance sports car. Sure, it is capable of incredible speed and massive gains, but man, it requires extreme precision to handle, or you are definitely going to crash. It achieves this 2 times leverage not by taking out a normal margin loan to buy shares, but through what's basically synthetic fuel, total return swaps. These are highly complex side bets with massive banks, designed to replicate the stock's movement without actually buying the underlying shares.
And the absolutely crucial point here is that 200% figure. The objective of this fund is strictly designed to track 200% of Dell's price movement for a single day. And I cannot stress this enough, not a single day longer. If Dell goes up 5% today, the fund aims to go up 10% today. It is not designed to give you exactly double Dell's cumulative return over a month, a year, or a decade. Just one single day. So, why does that one-day distinction matter so much? Let's move to Section 3, the daily reset trap. It's so easy for investors to have a really simple expectation, right? Hey, if Dell goes up 50% this year, my 2x ETF will go up 100%. Well, the reality is totally different. To hit those daily returns, the fund basically borrows against its net asset value, invests in those swaps, and then pays back what it borrowed at the end of every single day. Because it borrows and resets daily, a sideways or choppy market will literally erode your capital like a leaky bucket. It's like trying to run backward on a treadmill. You are constantly re-upping your risk after gains and reducing it after losses, and it completely breaks the intuitive math of long-term investing. And this daily reset trap feeds right into our next concept in Section 4, beware of volatility drag. Let's do a quick thought experiment over 2 volatile days. Say on day 1, Dell goes up 10%. Awesome, your DLL goes up 20%. But then on day 2, Dell drops 10%. You probably think, okay, I'm back to even, right? Wrong. Because of the compounding on that daily reset, a $100 investment in the normal stock drops to $99. But your $100 in the 2x ETF drops all the way to $96. Compounding in a volatile market mathematically destroys your long-term value, turning that expected 2x multiple into a really severe drag.
And listen, this isn't some weird glitch in the ETF's design. It is pure, unavoidable mathematics, known as variance strain. When you leverage a single, highly volatile tech asset like Dell, you amplify both the returns and the volatility. Because the math formula uses the square of standard deviation, when you apply a 2x leverage factor, that drag effect doesn't just double, it actually quadruples. Unless Dell's stock price goes straight up every single day without fail, the math is aggressively fighting against you.
But math isn't the only thing eating your returns. Let's explore Section 5, Hidden Costs and Risks.
Because DLL actively manages these over-the-counter swaps, it is incredibly expensive to run. First off, you are paying a hefty 1.50% net expense ratio. And honestly, that's only because they're temporarily waiving fees. The gross expense is actually 3.55%. Second, you have to navigate premium to NAV gaps. If the market panics, you might have to sell the ETF at a massive discount. Third, you're taking on counterparty risk with the banks issuing those swaps. And finally, and this is a big one, you completely miss out on Dell's recent 20% dividend increase because DLL pays zero dividends to its holders. None.
So knowing about Dell's fundamental boom, but also understanding the mathematical traps of the ETF, how do you actually use this thing? Let's wrap up with Section 6, your tactical investment guide. If you're going to wield DLL safely, there are basically 4 absolute rules you have to follow. Step 1. Utilize it strictly as a short-term tactical trading vehicle. It is designed to capture quick momentum, not to sit in your retirement account. Step 2. Continuously monitor intraday volatility, because those daily swings will destroy your capital. Step 3. Trade with extreme conviction. Only jump in when you strongly believe DLL is trending sharply in one specific direction. And Step 4, the golden rule, never ever buy and hold this long term. The math simply does not support it.
Ultimately, this all leaves us with a critical question. DLL is undoubtedly a powerful weapon in an AI bull market. But are you a tactical day trader or a long-term investor? Are you prepared to actively trade the daily waves of the AI boom, managing the volatility drag and premium gaps? Or are you better off simply holding the underlying powerhouse company and collecting those sweet dividends while their $51 billion backlog clears? It's a choice only you and your specific strategy can make. Thanks so much for joining me on this explainer today. Keep learning, keep questioning, and I will see you on the next one.